Hi, everyone. I'm Alexis Christoforous, and this is Midday Movers on Yahoo Finance, the biggest business news platform on the planet. Among the top stories on the move at this hour, GDP beats, consumer confidence soars, and the latest Case-Shiller home price index makes a new all-time high. We dig into the details on what it all means for the Fed. And AT&T just released prices for its DirecTV Now service. We'll tell you why the new skinny bundle might just be a cord-cutting sports lover's dream. And finally, the NFL's draconian social media policy isn't playing well internally. In a Yahoo exclusive, we'll tell you what our inside sources are complaining about. More on those stories coming up. But first, a quick look at the markets. And we've got an up picture on Wall Street today. The Dow Industrial is adding 32 points at 19,129. The S&P 500 adding 7 to 2208. And the NASDAQ Composite rallying 34 points to a new intraday high of 5403. Let's go right to the floor of the New York Stock Exchange, where Alan Valdes, Director of Floor Operations at Silverbear, is standing by with more. Well, Alan, another slew of macro data today covering broad swaths of the economy, and all of it positive. The big number, of course, third quarter GDP was revised up to 3.2%. That was above expectations. The Case-Shiller home price index rose to a new record, taking out the high from a decade ago. And consumer confidence came in far above consensus at 107.1. It was the highest, by the way, since the Great Recession ended. So, Alan, what do you make of all this data, and how do you see it shaping investors' opinions about stocks and bonds?
Well, I tell you, you're right. It was great data across the board. I mean, just that housing number, they were the best numbers for housing since really the Great Depression. The last 10 years, they've been the best numbers. Consumer confidence, like you mentioned, hand in hand. And I'll tell you, the consumers have to love it. And I think investors are now going to take a real serious look at the stock market. The market's been great for the last 8 years, really, but on no volume. The average consumer has not been in the market. The average investor has not been in the market. It's been buybacks and the Fed's juicing it up. But I think you're going to see right now, with consumer confidence the way it is, I think you'll see investors get back in the market in January.
Now, of course, jobs are in focus big time this week. ADP payrolls tomorrow, the big monthly jobs report Friday, which, by the way, this will include data after the election. What's the market expecting there, Alan?
Well, you know, we're looking for 175 to 185, probably right in the middle, 180. If we get that number, that's a great number for us. That's a great number. The Feds are definitely going to raise if you get that number. They're probably going to raise anyway, unless the number's totally terrible. But I think in general, you get that number between 75 and 85, you're going to see a raise a couple of weeks, and it's off to the races. I think January, probably till the spring, you're going to have a great market here.
Now, we've got the FOMC meeting in 2 weeks with the Fed rate hike, as you said, widely expected. But we know that everybody's going to be parsing the language in that announcement for clues about what will happen to rates in 2017. Now, given this spate of good news we just got, what does that picture look like for you in the next year?
Well, you know, all things being equal, if we stay on this track of solid growth here, not only in numbers, but in, like you mentioned, the macro news coming out of Washington, you could see a strong first, second, and maybe third quarter going into next year. There's no question about it. You got a new administration coming in. They're promising tax cuts. They're promising more jobs. They're promising less regulation. So overall, it's all positive for the market. And like I said, we got billions coming, maybe coming repatriated back into the United States from companies overseas. That number, those monies are going to be put to work. So overall, you can see a strong market coming up the first couple of quarters here.
All right, if Trump's tax plan gets the okay, we will. All right, thanks a lot, Alan Valdes. Thanks so much.
Thanks, Alexis.
And joining me now to discuss some of the other big stories of the day are Yahoo Finance's Rick Newman and Dan Roberts. Great to have you guys with us. All right, it has been a banner day. We've been talking about it for U.S. economic data. So we want to focus now on the Case-Shiller home price index, which climbed 0.5% in September to set a new all-time high, wiping out all the declines from the Great Recession. Now, on an inflation-adjusted basis, it is still 16% below that 2006 high. However, home prices have increased 5.5% over the last year. Rick, I know you're writing about this today. On the surface, this looks like a great number for everyone, but you're saying not everyone is enjoying this bump up in housing.
Well, it's a moment. Let's appreciate that, first of all.
Okay.
I mean, the housing bust was ferocious. I mean, you know, the biggest loss in housing wealth certainly since the 1930s. And by this one measure, we're back in nominal terms. You're right. When you adjust for inflation, we're still behind. But we've reached at least this threshold. And, you know, these have been steady gains. I mean, it's been 3%, 4%, 5% per year, which is per year, which is what you want to see in the housing market, not 10 to 12%, which we saw during the housing boom. So that's the good news. The bad news is we just have fewer people, a smaller portion of the U.S. population participating in the housing market these days. So this benefits fewer people, and no surprise here, it tends to benefit the wealthy a lot more than everybody else because their assets have reappreciated the most, and they're getting the most out of this. So the home ownership rate has actually fallen quite a lot since it peaked around 2006. It hit almost 69% is where it peaked. It's now down closer to 63%. So that's several million people who would have owned homes had we been back toward where we were, who don't own homes now. They're renting, and they're not getting the benefit of home equity or rising property value.
And it is the largest investment for most people. So I would have to think, though, that a lot of not wealthy folks are seeing their largest asset appreciate, and that's got to be a good thing.
Yeah, so this builds real wealth for people, so it contributes to this thing called the wealth effect, where people, even if you don't, you can get a home equity loan, but you don't just take the housing wealth and go spend it, but you feel better off.
Right.
And you feel maybe you can count on this for retirement, and that makes you more willing to spend money on other things, commit to bigger purchases. Certainly home improvement, that's an important part of the economy, appliances and everything that goes with it. So in that regard, this is good news.
Now, talking about those people who are not part of the home ownership crop, right? A lot of them millennials. What are some of the barriers that exist right now for home ownership for millennials?
Yeah, as Rick said, I mean, the ownership rate is down, and it's especially down among young people. And that's what interests me. I mean, my generation. And I just saw a headline a couple days ago wondering, what if young people never end up buying homes? I mean, some people still predict, well, wait, maybe it takes a little longer, but eventually they will age into that generation where they do buy homes. But of course, the rates are way down, and the problem is, on the other side, we're also getting squeezed with rental prices. And as Rick was saying before the show, well, when the rental prices go up, that helps with ownership, and maybe it drives people to buy. Now, to use anecdotally an example among my own friends, and of course, New York is never a great example for anything.
Yeah, it's an
But
anomaly,
Here in
but
New York
okay.
City, I mean, I know a lot of people who have moved toward buying an apartment because they just feel like, I'm paying rent every month and the landlord has all the power. They keep rising rent every year, so I might as well buy. But I don't think that's the norm. And, we talk about how it's now a rental economy. It's no longer an ownership economy. It applies to car sharing. It applies to Airbnb. And, we talk about how millennials are buying fewer cars, or at least that was the myth for a while. Now that doesn't seem to be as true. I do think that in the end, everyone kind of ages into this. I mean, it's separate, but
Because
we talk about
life
golf a
happens,
lot.
you get
It's the same
married, or
kind
you
of way.
have kids, and
Yeah,
But don't you guys just want to own tiny homes in Brooklyn? 50 square feet or whatever they are?
Look,
the tiny house thing is a phenomenon. There were shows about tiny houses.
Yeah, I mean, I think that, there's sort of a lot of hue and cry, and that eventually everyone sort of becomes like their parents. And I think that even as the economy has changed so much, that still tends to be the case in a lot of examples. I write a lot about golf, and people worry that, golf viewership has gone down. Are people going to be golf fans? Well, give them 20 years, and eventually they'll want to watch golf. And it's kind of the same kind of anecdote, because the people who aren't buying now, eventually they'll be motivated.
So we are going back to a more normal housing market, but some things are going to change in a fairly permanent way. For example, more people are moving back to cities, and that changes the homeownership equation.
That's the end of the suburbs. Yeah.
It's not the end of the suburbs, but it might be the end of the exurb.
For some people,
sort of the distant suburbs. So that changes the equation.
So might we see more home ownership in the sense that condos, co-ops, apartment ownership?
But then as people establish roots, what else do they need? They have kids and they need good schools, so they will go where the good schools are. That will be one thing that does get people out to the suburbs. But one other thing I think is really important that I hope a lot of people have figured out, which is you need to stay very mobile in the economy we have, because just because you have a job or an opportunity in one place right now, things change really fast, and you may have to get up and move, and it can be hard to do that if you are locked into a property, especially if you overbuy. So one thing I think is a thing of the past is, you remember when maybe your parents, certainly mine, said, oh, when you're buying that first home, just stretch a little bit, you'll grow into it.
Right.
I think stretching is a bad idea.
Yeah.
I think you should underbuy, make do with a little less space, and retain more flexibility and mobility than you might otherwise.
Well, this is why that mortgage startup came under hot water during last year's Super Bowl. There was that Rocket Mortgage,
that's right.
and they ran ads saying, get a new mortgage with the tap of 2 buttons, and you have a mortgage. People said, let's maybe not encourage everyone to get a home mortgage with 2 buttons, okay?
Yeah.
That was what happened in 08. I mean, people
At least we're
overstretched.
giving
Let's
it a second
take a
thought.
moment and think about it.
Yeah.
All right, well now let's move on to a new entertainment option that cord cutters can use in their homes or take on the road. AT&T's new DirecTV Now streaming service goes online tomorrow, offering packages ranging from about 60 channels for $35 a month to 120 channels for $70 a month. This is the latest development in the so-called over-the-top technology that eliminates the need for cable or satellite subscriptions. You're writing about this one today, Dan. You say this is particularly attractive for sports fans. Tell us why.
Absolutely. This is what interests me, is the kind of inexorable march toward cord cutting and toward no longer needing to pay for cable. And every few months now, we see a new option announced. We just spoke on this show a month ago about the Hulu package, and that was another kind of incremental big step. But this one is great. I mean, if you want live sports, and now you can get ESPN, FS1, and a number of other things for $35 a month at 60 channels, I think that sounds pretty good. And we've long said that live sports are really the last remaining holdout, the last reason to pay for cable. But now you're finally starting to see, not yet a la carte, which is what everyone wants, but marching slowly toward a la carte. You know, you still can't get just ESPN. If I wanted to, I'd pay a flat fee per month to just get ESPN on all platforms. You can't really do that.
Well, it would matter on what they're charging you, right? I mean,
well, right, and so
they still have the pricing power.
Yeah, and that's true. But depending on what device you have, now you have a lot of options. You have Vue, VUE on Sony PlayStation. You have DirecTV Now. You can do Hulu. Amazon is trying to get into this game and buy up a lot of these sports rights. We've just seen a scoop last week from the Journal saying they're trying to convince the NBA to make its league pass Amazon only, which the NBA won't do. But the point is, all of these big giants see that this is where things are heading. They're finally starting to cater to cord cutters.
What do you think matters most in these so-called skinny bundles? Is it price? Is it selection? What's going to, move the needle for people?
I think it's at least two things. So price is obviously motivates a lot of people. Cable is expensive, there's no doubt about it. I think simplicity is another factor, though, that we don't yet have in a lot of these bundles. For example, CBS is not part of the new AT&T offering, right?
True.
So you can get most NFL games, but not the ones on CBS.
And
so
you can't get NCAA.
And
There's always a catch.
There are these other restrictions, and I think this gives me a headache personally. looking through. I've already got a million decisions to make in life, and how long am I going to spend optimizing my cable package? So there's some of us who say, you know what? I might stick with cable just because it's simple.
Yep.
Right.
I am willing to pay for the simplicity. I know I can get everything I want, and when there are better options that are more inclusive, I'm ready to cut.
That is
but
the argument.
Let's improve the offerings, and I'm not entirely sure that's going to happen because there are so many. The rights are sliced and diced in so many different ways for so many different types of programming. So I mean, we're used to the idea of having a basic package that you layer on. Like we're good with that. I don't think we're really used to having like 3 or 4 different subscriptions in order to get everything we want. So if we could ever get to a la carte, that would be a way to do it, but that might end up being too expensive.
Well, look, you say, you don't think it'll ever get to the point where you can slice everything up, but we already have gotten more to that point than we were. I mean, 10 years ago, you couldn't get ESPN on anything but ESPN, the TV channel.
Right, it's
and now
moving
you can
quickly
get it on a number
now.
of different devices. What you still can't get is a ESPN-only app where you just pay for the app, but you can get that with HBO. I mean, that was huge. That can't be overstated. When HBO said, we're going to offer an over-the-top service, and you can pay a monthly fee and just get all HBO series on your iPad. That was a really big step. So I do think we're seeing incremental progress.
And this is all happening because of over-the-top streaming. That's the thing. That's the enabler here.
That push
and it's kind of like we're going through a lot of fragmentation before we get to something that feels orderly.
Yep.
So right now it feels very fragmented.
I'm with you.
You're right. I mean, we can see it kind of coalescing, but
I'm
not quite there yet.
I'm confused, and therefore I stay with cable for now.
Well, go home, spend 3 hours, and sort it out.
I'll do that this weekend. All right, let's stay with the sports theme, shall we? And bring you an update about the NFL's new social media policy that went into effect last month. Now, halfway through the season, and it is hugely unpopular with many of the league's 32 teams. One part of the policy, teams can be fined as much as $100,000 for posting game video to their social media accounts before the league makes the video available. Man, do they just keep that hold over that video, Dan. You're covering this one today, too. What do your sources have to say about how this policy is working, or should we say not working?
Well, it's really fascinating, and it actually kind of has tentacles that touch a lot of different people. It touches media outlets that cover the NFL and want to post their own video content. It touches the NFL teams, and it's really about a push and pull between the league and the teams. Now, you would think that those guys would be in sync, but what the league always wants at the end of the day is for people to look at the NFL and look at the league above all else. They want people to be fans of the NFL. And what the social media people who work for a team say is, well, that's not how any football fan operates. I mean, Rick is a big Steelers fan. I'm a Patriots fan. I don't say, oh, I'm a big NFL fan. I'm a fan of the Patriots.
Right.
And what the league is doing is saying, we don't want you to post any video content during the game window. Now, that's not new. There was always a game window, and it extends until an hour after the game ends, which seems kind of crazy and draconian. What's new this season is you can be fined for posting any in-game video footage that we haven't posted first to a library, a bank, from which the teams pull content. Now, their complaint...
How do they even know what has been aired and not?
Well, so there's sort of a network from which you, an NFL team's social media person, can pull a video clip once the official NFL social media people have put it in there. But their biggest complaint, and I agree with this, I mean, it defeats the in-the-moment purpose of social media, is that, let's say Rob Gronkowski scores a touchdown and does a cool dance. The Patriots social media guy wants to post that video right now.
Right now, yeah.
But the NFL, it might take them 8 or 9 minutes to post that clip to that library. Well, it's already dead by then. 8 or 9 minutes later, the Patriots could be losing. I mean, NFL, you know, they have to understand that social media is in the moment and now.
So, all right, you are a football fan, we know. Does it matter to you where this video is coming from?
It doesn't matter to me as much personally because I don't need to see it right that second.
Okay.
But I think it does. I think it matters. I mean, because the NFL is fighting the very nature of social media, which is that it breaks down boundaries and it lets everybody participate. And they're trying to retain the walled garden. That's the phrase we used back in the 90s to describe the way media companies try to keep control of their content. You can understand why they want to because that's the value.
Right.
And the value of the league is in the content. But they're sort of fighting a losing battle here, it seems to me. They have to find a way just to get it out there. And, you know, they're basically saying, trust us, the middleman model will work. The whole internet is about eliminating the middleman.
Absolutely. Look at Donald Trump's campaign.
Get with it.
Right?
It comes right from the guy himself.
Yeah.
And I should mention here, when we talk about the policy not working, that what I hear is the NFL is actually likely to announce a change to the policy very soon that shortens that game window rule. Now, of course, people are skeptical whether that will improve anything, but
Baby
it
steps.
just shows they keep having to make changes.
By the way, that phrase, social media policy, is an oxymoron.
That's right, you're right. Well, you know what, there's
When you have a policy about social media, you're doing something wrong.
They need to come into the 21st century.
Use it.
All right, Rick and Dan, thanks for being here as always, and that is Yahoo Finance's Midday Movers for today. Post a comment below or on Facebook and Twitter. Thanks so much for joining us. We'll see you right back here tomorrow.